Welcome to LevFin Insights podcast series, Levered Lines. I'm Luke Miller, Global Editor-in-Chief at LevFin Insights. I invite you to listen to our series of podcasts where we interview key market participants as we look across the main themes impacting the leveraged finance markets. And with that, over to the team.
Welcome, and thanks for tuning in to LFI's Levered Lines podcast. I'm Tom Davidson, one of the senior editors at LFI here in New York. We're going to be talking about US loans and a little bit of US CLOs today, so I'm very glad to be joined by a guest who can really dive into the detail of that. So great to have Corey Geis with me. Corey is Global Co-Head of Liquid Credit at Investcorp. Corey, welcome to the show.
Well, thank you very much, Tom. I appreciate that. Thank you for having me.
Great. Now, we've got a lot to talk about today. I feel there's always a lot to talk about in the loan market. Some of our topics are the return of M&A, portability provisions. We want to talk a bit about relentless spread tightening, what that means for CLOs, and of course, everyone's favorite default, first brands. But I think before we get into all of that, Corey, could you just introduce yourself to the listeners?
Sure, it'd be my pleasure. So as Tom mentioned, I'm Corey Geis. I'm Global Co-Head of Liquid Credit at Investcorp. I've been in the levered credit markets for well over 30 years. At various shops on the street, really cutting my teeth in credit trained at NatWest Bank when they still did that at money center banks. But I've spent time at TD Securities, Golden Tree, where I was a partner and ran trading globally for them for many years. Marble Point Credit, which was founded by Tom Shandell, and Tom Shandell and I ran Marble Point and really built that from nothing to about $8 billion of AUM. Ultimately sold Marble Point to Investcorp in 2023. It really gave Investcorp the critical mass that it needed in the U.S. market and the U.S. credit markets, and provided Marble Point and its credit team, a global reach, quite honestly, because Investcorp is in fact very much a global asset management firm with $60 billion of AUM, really three main verticals, private equity, middle market private equity, which also includes GP stakes, real estate and infrastructure, and then of course credit, which is predominantly liquid, broadly syndicated loans, and CLOs in particular, and private credit.
Great. Well, let's get on to the loan market and do a quick overview. Corey, what's your take?
Yeah, current take on the loan market, it's it's still robust, right? It's still quite strong. I think the technical that we've seen for the better part of the last few years, in terms of that strength of the market, is still there. Now, with that said, over the last couple weeks, right, we've seen a little bit of weakness, right? But that's welcome, quite honestly. And that weakness is being driven by really predominantly a couple things, right? A couple factors. We've actually started to see some new issue, right? We've had a dearth of supply, a new issue supply for the longest time. And the pace of CLO issuance, right, has really outpaced the pace of new loan creation, new loan issuance. So for a long time. And that finally started to reverse ever so slightly. And as managers, we need to make room for those new facilities. And so whereas, at its peak, we had north of 65% of the loan market trading above par, now we're down to 30, right? That's still a lot, particularly when you consider that a significant portion of the loan market has already been repriced, refinanced. And you think about, the issuance this year, only 20% of it has been true new money, right? Really, just less than that, 19, believe it or not. So that 81%, right, was all refi and repricings, So that's been the story, right? That spread compression that we've seen on the underlying assets has been significant. But, what we have been able to see is an ability for managers to reset and refinance their capital structures of their CLOs. And that helps to offset some of that spread compression. The other leg to that stool in terms of what's happening in the loan market is that we have to be very mindful of the tails, right? Mindful of the risks that are going on in the market. And that is really become an ever increasing focus for all of us as credit managers. Obviously, the advent of LMEs over the last few years, right, has been significant. And, it's changed the way that, we've had to think about how we manage credit a bit, right? And how we manage those tails. So that's something we're all keeping an eye on. But I think it's healthy. I think what we're seeing happening in the market is healthy. I think the pullback that we've seen over the last couple of weeks is healthy. I'd like to see a little bit more of it, if I'm being totally honest, right? I think we want to see those opportunities as managers. We want to be able to trade our portfolios. And, at Investcorp, we're very focused on relative value trading, right? And that lends itself to us being a very active manager of our portfolios. And nothing allows us to rel val trade more than volatility.
Yeah, it's really interesting you say that. And I think one of the complicating factors over the last few weeks is that we've definitely, I think, seen the banks starting to push some perhaps more challenging credits out there. So some of the names which have got into trouble in the new issue market seem to be ones which were perhaps always going to be a bit of a stretch for the market.
Yeah, that's a great point. I mean, there's definitely been a little bit of pushback, right, on a handful of deals of late. There's been significant froth in the market, right? So until the market pushes back, right, issuers and cap markets, they're going to keep pushing, right? They're going to keep pushing on behalf of their clients, to see what the market will bear and what the market will absorb, right? And we've really started to see perhaps the introduction of a little bit more discipline, which I'd love to see the market exhibit. That's been refreshing, but really on the whole, the dynamic is still quite strong. The technical is really still quite strong. The demand is strong.
Yeah, I was going to say it's a pretty minor pushback.
It is.
There's still some of the better names with good ratings still seem to be going
Absolutely.
through very tight.
Those names, like our market is dominated by CLOs, right, which represent about 3/4 of the market, and those names with the right ratings profile and spread, although it's hard to find spread these days. Those will always be attractive for CLOs, and that's still the case today.
Yeah, great, Corey. Well, let's move on. You mentioned new money. We've seen a slew of recent M&A coming to the market, and obviously providing some much needed new money for the loans. I guess what's your take on that? If we're going to see that continuing, and probably connected to that, I think your view on rates as well.
Yeah, no, it's a good question. It's the right question. Yeah, we've seen some new money, right? We just saw the largest LBO issuance, in Dayforce since February of 2022, when we saw Athena Health, come to market with $6 billion of term loan. So that's a significant mile marker, I think, for our market. And then, of course, Electronic Arts is out there looming with probably $20 billion of financing, which will, in all likelihood, tap every market, right? BSL, private credit, senior secured notes, unsecured. I mean, everyone's gonna be able to swim in that pool, right? So, and they're gonna need that. So it's really interesting, right? And I think what we have as a market been hoping and expecting that we would see, certainly at the beginning of this year, right? Tariffs kind of derailed a lot of that. But that's, tariffs, are really become a bit more in the rear view as we get a bit clearer picture about kind of how that landscape is going to look. The rate picture that you bring up. So we've had one cut so far. Okay. Think we'll get one more at least before the end of the year. I know many are calling for two. That will probably really depend on what the jobs picture looks like. Right now, we seem to be outsourcing the Bureau of Labor Statistics to ADP and to the street, right? Particularly with the shutdown. But the picture looks weaker for the job market, right? And so that probably means we will see a few more cuts. And then, of course, Powell, his term's going to end, I believe, in May of next year. And President Trump will put his person into the Fed, appoint his person, and in all likelihood that person is going to do their best to carry out an agenda of lowering rates, even further, right? What that will serve to do, and you're starting to see that now. You're starting to see those green shoots because of M&A and LBO activity. And in fact, LFI put out a piece a month ago, talked about letters of intent, right? And how letters of intent have increased 30 to 50%, right? And is that a harbinger of more deals to come, right? And so I think it is, and we all know, it's been well documented, that private equity needs to move assets off their books, return capital back to their investors, their investor base, right? Increase DPI. So that deal flow is on the come. What lower rates will do is that it'll help to serve to narrow the bid-ask spread that we've seen between sellers and buyers of these assets for so long, right? Private equity, the holders of assets have been hesitant to really sell at lower valuations because they bought those assets at higher valuations when rates were lower, and buyers have been hesitant to buy, at these valuations. Well, if you lower rates, you've lowered the discount rate, right? Valuations should increase. That bid offer spread should narrow, and that, I think, is what's going to spur deal flow. Right now, deals take 3 to 6 months to germinate, and everyone will. Every issuer, seems to follow a parallel path along the broadly syndicated market and the private debt market, and then make a decision kind of at the 11th hour, right? But BSL will get their share of that activity. As we've just talked about, there has been new issue, actual real new loan creation, and I think we're going to see more and more of that, particularly as this rate picture continues to evolve.
Yeah, and Corey, I think. First of all, thank you for the shout out. Glad you're reading and enjoying. But I do think recently it feels as if we've seen a few more wins for BSL over private credit in these parallel tracks. Yeah.
No, it's a good point. I mean, look, private credit's not going anywhere, right? It's a massive market, right? It filled a enormous hole, that was left by the banks. It's larger than the BSL market, marginally, right? But what we'll continue to see is sort of like that pendulum just swinging, right, back and forth. And as you said, BSL's been able to take some share. Well, why is that? Because you had a number of issuers that were able to tap the private credit market that perhaps were a bit too levered, right, and wouldn't necessarily garner at least at minimum a B3, B- rating, which we all need, as CLO managers at minimum. Or they had recently acquired a company, right? And there needed to be a bit more proof of concept in terms of their ability to execute on their plan, right? And but now, or they're just smaller companies, and they needed to kind of grow into their capital structures. But now, we've seen some of those companies kind of season themselves, in the private credit market, and that allows them to then transition to the BSL market, where they can get tighter spreads on their capital structure. It's a different market, of course, for them, but it really is, it's an opportunity for them to show that they've matured, right, as an issuer. And so I think that's why we've seen that pendulum swing a little bit to the BSL market. It'll go back and forth, but for now, BSL's been able to take back a little bit of that share.
Great, Corey. And talking about the pendulum and the tools, one of the things which BSL is deploying at the moment is portability clauses, one of LFI's favorite topics. For people who aren't familiar, it basically allows a borrower's loans to remain outstanding when there's a change of control event, like some M&A or something like that. What's your take on portability?
We would prefer not to have it. It's not something we prefer to have in our agreements. I think, when there is a sale, typically that's an opportunity as a lender to then reevaluate this new situation, right, and determine whether or not you want to continue to participate as a lender. So it's not ideal, but it has crept into the market more and more. A lot of it driven by the fact, as I said earlier, the private equity owners of these assets, they need ultimately to return that capital back to their investors. How do they do that? They need to sell. They need to monetize assets. Well, having portability in their structure, they could do a dividend recap today, return some capital to their investors, have the portability, and not have to worry about going back to the market. That buyer will have the certainty, right, of financing on that underlying asset. So I understand the attractiveness for the issuer, for the private equity community that owns that issuer, and we just need to be mindful of that. I mean, it forces us as credit managers to really be mindful of our credit selection process and to do our work. And I would say at this point in the cycle, that's as important as ever.
Yeah, and I think we'll be coming on to that a little later as well with questions. Maybe just let's pivot a little bit and talk about portfolio strategy. Basically, what is your portfolio strategy and how's that been evolving with the market?
Yeah. Look, at this point in the cycle, really for the last few years, we have maintained more of an up in quality bias in our portfolio. I mentioned earlier, the significant spread compression that we've seen over the last few years, really starting in earnest in 24. And you're just not really getting paid for that incremental risk, right? When you look at the difference between, the spreads between a B1, a B2, a B3, there's not a whole lot of difference, right? So if you're not getting paid for the incremental risk, you're going to want to skew more toward safer credits. And so that's what we've been doing. It's a balance, of course. You can't just buy double Bs, in this market. But and not all B3s are bad, right? There are quality B3 issuers. Comes back to what I said earlier about credit selection, about maintaining, being true to your process. Yeah, I think that bias, that kind of up in quality bias, still really is the focal point, given where we are at this point in the cycle.
Yeah, and obviously a lot of managers say the same thing to me, and a lot of them point to LMEs as being the real game changer for them. Is that your take as well?
Yeah, I mean, look, LMEs have changed the way that we have to look at credit, right? We have to be mindful. There was a time when we would look at credit and if it started, get into that kind of more distressed, zip code, your analysis would look at, okay, well, what do we think, the valuation is, right? What do we think that ultimately this company is worth? Or where am I creating this, this company at the press valuation? What do I ultimately think it's worth? And that's not really the first thing that we consider now. You actually consider, okay, well, am I going to be in this have or have nots group, right? Because it's very real, right? In terms of, the difference in recovery between the haves and the have nots. And we have to make that determination based on, ironically, based on the amount of that credit that you own. So the more of that bad name that, or distressed name or stress name that you own, the higher likelihood that you're going to be in the steer co or the opco, right? And the less you own, the higher likelihood you're going to be on the outside looking in. I think what we want to do as a manager, at least in Investcorp, is try to identify those situations sooner, those problem situations sooner, and make a determination about what we want to do sooner. Do we want to exit, right? It's better to exit that credit at 95 or possibly even, in the low 90s, right? Than ride it all the way down to 40, right? So it's really it's such a significant factor in our market now, LMEs, and I don't think there are any winners. I think the only winners here are the financial advisors and the lawyers, and this is not a knock on them at all. But I don't think that the lenders are really winning, and statistically, right, the market would show you that that those credits, those issuers that go through an LME, are typically back at the table 6-12 months later. And all they've done is erode value, right? So I I think it's a vicious cycle we're in with LMEs, but the way to counteract it is, again, credit selection, being true to your process, and identifying those situations sooner and making a quicker decision about what you want to do.
Yeah, great. Well, let's stick with defaults, and we should talk about everyone's favorite default at the moment, First Brands. In Chapter 11 now, came out of nowhere from most people's perspective. I think I was looking 9 billion of kind of like acknowledged debt, unclear amounts of other debt floating around, 4 billion more or less exposure for the US loan market. I think pretty much every CLO manager had some exposure. How are you dealing with yours?
I'm very happy to say that we did not own any First Brands.
Wow.
I give a lot of credit to our team, to our investment team. This was a situation where, look, you can't really underwrite fraud or deceit, and that's what's happening here, right? But you do have a situation where the CEO and founder, Patrick James, he owns 100% of the stock. There is no independent board, right? Oh, by the way, he was also, sued for fraud, multiple times, going back, maybe almost 10 years now. And I think he settled in those cases, but, that's part of the diligence, right? That you have to do, when not a lot of people talk about ESG anymore, right? That's so, 2, 3, 4 years ago. And now we're talking about AI and LMEs, it's different acronyms, but when you think about ESG, the G, right? The governance portion of it. And when you don't have an independent board, right, you're exposed to these types of risks. You're exposed to these risks of fraud. And, that's something that's a real hot button issue for us. It's not to say that we get every credit right, but, I'm thankful that we got this one right. And that was really tied to the fact that, all the cards, if you will, were held by the CEO and the founder, and, all the off balance sheet financing and vendor, pledging collateral multiple times over. I mean, these are the things that can happen, and you got to really be, really tread carefully in these types of situations.
Yeah, and I think it brings up a really interesting question. Obviously, as you say, it's a one-off. You can't underwrite for these things, except you kind of did underwrite for these things. Is this a one-off for the market, or is it a reflection on some issues in credit quality in CLO portfolios that we need to keep an eye on?
I like to believe that this fraud is a one-off. I think within private credit, it's harder to know because there's less disclosure. So there are probably greater risks, within private credit, for something like this to happen. But again, that comes down to your underwriting standards and your due diligence, as a manager. But I don't think that this really is indicative of a broader issue necessarily at play. I think the technical is still, as we discussed, quite strong. I think, earnings have actually been pretty decent, right? So I would like to believe that this fraud, is in fact a one-off situation. But it doesn't mean that we can be any less diligent, right, in our credit selection process. I mean, that's what helps avoid issues like this.
Okay, great. Well, I want to pivot a little bit to CLOs, and it is connected to First Brands. First Brands has obviously hit the CLO market pretty hard. A lot of CLO investors are a little panicky about it, and I guess one of the reasons is that from an equity perspective, they've already been suffering somewhat from the compressing loan spreads. Yeah. So given that, and the fact that we're seeing a bunch of loans come to primary at S plus 175, some even at S150, does that actually work for a CLO?
I guess it depends on the vintage of your CLO, right? If you were fortunate enough to, price at, the tights earlier this year, maybe the 175 works at the margin, it might be break even. Hard pressed to see 150 working for CLOs. Generally, I'm not particularly fond of, these plus 150, plus 175 loans. I don't think they're overly accretive to CLOs. But, we own some of them. They're high quality issues. We own them because, much like a lot of other managers, the market was under this massive repricing wave, and we couldn't necessarily afford to, let some of these larger positions go. Now, the way you can mitigate that is to start to reduce those positions over time, right? Manage your way out of those positions, through swaps, and we've been doing some of that. But for the 175s that we have, we're generally comfortable, but you're not going to be able to own a lot of them, because it will really impact your weighted average spread, of your CLO, and we're struggling enough, just given all the spread compression we've seen.
Yeah, and I guess that kind of brings me to the CLO arb, which is always a topic of interest. And we've seen, I think, first of all, it's been a good year for CLOs.
Yeah,
it's been a good year for CLO new issuance. Yeah. It's been a good year for CLO refinancings as well. That said, September has definitely been a slower month. Yeah. Been some drop off. I guess that's a combination of CLO arb, loan supply. Want to get your take on if we're going to see issuance pick up for the rest of the year, or if we're going to stay slow.
Yeah, it's a good question. I think that we could see CLO issuance pick up a little bit if we continue to see, this momentum in new issue continue. To me, that feels like it's a little bit more of a 26 event, where you really start to kind of see that take off. But it doesn't mean that we're coming to a grinding halt. And while the ARB is challenging, it's not necessarily impossible. We also have the benefit of, managing these vehicles over, a 7-year average life, right? And producing value for our investors over that time, thankfully. And you would expect that you would see pockets of opportunity, right, over that 7-year average period. But yeah, I think, we'll see some CLO creation, but for me, I think what the market's really giving managers is this opportunity to refi and reset, as you mentioned, right? This is the way that we can combat those tightening spreads. Now, we can never do it lockstep with the market, right? Because typically most CLOs are, non-call to vehicles, right? When they're issued. So you're not able to really refinance that capital structure for 2 years. But when you can, in a period like this, and that window's been open for several months now, you're going to refinance those higher spread 2023 vintage CLOs and soon, 2024 vintage. And that's how you're going to combat those tightening spreads, through refinancing your capital stack at tighter levels, which hopefully improves that ARB, for the vehicle. And resets, it's kind of a similar, kind of gift, if you will. Many times you can refinance tighter, but of course with a reset, you're extending your reinvestable life of your vehicle, right? Usually for another 5 years. It gives you an opportunity to really produce and add additional value for the benefit of your investors.
Great, Corey. Well, I could talk CLOs all day. Sadly, we're pretty much out of time now. So thank you so much for joining me. It's been a really interesting discussion. And thank you, everyone, for listening.
Well, thank you, Tom. I really appreciate you having me. I've enjoyed our discussion as well.
This podcast should not be copied, distributed, or reproduced in whole or in part. Neither LevFin Insights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. LevFin Insights is not providing investment, legal, accounting, or tax advice. LevFin Insights is not providing research or making any recommendations, nor is LevFin Insights offering or soliciting any transaction with respect to the purchase or sale of any security that the listener may hold.